Look at this chart. Oil just did a backflip. In about 10 weeks, the price of crude went from roughly $70 a barrel to $126, and then fell straight back down into the 70s, where it is as I record this. Gas at the pump touched $4.30 a gallon, the highest in years, and now it is sliding back under 4. That is not a market. That is a heart monitor. And the reason it spiked is the part everyone gets right. There was a war. On the 28th of February, the United States and Israel hit Iran. Oil panicked. Simple. But here is the part almost nobody can explain. The barrels you were terrified of losing mostly never actually went missing. The price went vertical anyway. And by the end of this, you will know exactly who reached into your wallet while you weren't looking, and why your gas got expensive for a shortage that, in the worst case, barely happened. This is what oil really is. Not a fuel. A fear gauge for the entire planet. Let me show you. Start with the lazy explanation, the one your uncle posts on Facebook. We ran out of oil, or greedy oil companies jacked up the price. Comforting. Also wrong. Because the world did not run out of oil. The world has never had more oil. The United States is now the single biggest oil producer on Earth, pumping a record 13.6 million barrels a day. We are drowning in the stuff. So if there is plenty of oil, why did the price nearly double? One word: geography. Look at a map of the Middle East. There's a tiny pinch of water between Iran and Oman called the Strait of Hormuz. At its narrowest, it is about 21 miles across, and the actual shipping lanes the tankers use are only about 2 miles wide each way. A strip of sea you could cross in a speedboat before lunch. Through that one straw flows about 20 million barrels of oil every single day. That is roughly a fifth of all the oil the planet burns, and about a quarter of every barrel that travels by sea. The people who measure this stuff, the Energy Information Administration, have an official name for it. They call it the world's most important oil transit chokepoint. So picture it, one narrow gap, a fifth of the world's oil. And on the 28th of February, the country sitting right on top of it gets bombed and announces it is closing the door. That is the whole trick. Therefore, the moment Iran threatened that strait, traders did not wait to see if a single tanker actually got stopped. They couldn't afford to. Here is the thing about oil that makes it so violent. You cannot stop buying it. When the price of a designer handbag goes up, you just don't buy the handbag. When the price of oil goes up, you still have to drive to work. The truck still has to deliver your groceries. The plane still has to fly. Demand barely flinches. Economists have a word for that: inelastic. But you already know the feeling. It is the feeling of having no choice. And when buyers have no choice, even a tiny threat to supply makes the price explode. So traders, refiners, airlines, all of them rushed to lock in barrels before the worst could happen. That panic buying is what actually moved the price. Not lost oil, feared oil. And that fear has a price tag, a real one. The bank Goldman Sachs ran the numbers and estimated that, at the peak, about $18 of every barrel was pure war risk premium. Not supply, not demand, just fear. That was roughly a quarter of the entire price of oil, a tax on a catastrophe that hadn't happened yet. And guess who pays that tax? Watch this number. Crude is about half the price of a gallon of gas. So when oil jumps, your pump jumps about 2.5 cents for every dollar the barrel moves. Oil ran up more than $50 a barrel. Do that math at the station. That is you paying $18 a barrel of someone else's anxiety, one fill-up at a time. Now, before you say, fine, I'll just drive less, I need you to understand how deep this goes. Because oil is not gasoline. Oil is the master ingredient of the entire modern world. The planet burns about 103 million barrels of it a day. It is still the single largest source of energy we have, around 30% of everything, and almost none of that is you, personally, at a gas pump. It is the diesel in the truck that brought your food to the store. Trucking moves about 70% of all freight in America, and fuel is its single biggest cost. It is the jet fuel that is up to a third of your plane ticket. It is the plastic in your phone case, your water bottle, your car bumper. Nearly all plastic is made from fossil fuel. It even reaches your dinner plate, because the same energy shock that hits oil hits fertilizer, and fertilizer is what grows your food. So when oil spikes, it does not just cost you at the pump. It quietly raises the price of nearly everything you touch. There is a famous finding by an economist named James Hamilton. 10 of the last 11 American recessions were each preceded by a spike in the price of oil. 10 out of 11. Oil does not always cause the crash, but it is standing at the scene of almost every one. And this is not new. In 1973, an oil embargo sent the price up about five-fold and gave America those famous gas lines wrapped around the block. In 2008, oil hit $147 a barrel, months before the entire economy fell off a cliff. Same pattern every time. Oil spikes, and a few months later, the recession shows up like a guest nobody invited. So now you understand the stakes. A fifth of the world's oil behind a 2-mile-wide door in a war zone attached to the price of basically everything you buy. And in the spring of 2026, that door kept slamming. There was a ceasefire in April, and oil crashed. Then it fell apart, and oil ripped back up. The United States put a naval blockade on Iran. Iran closed the strait a second time, and on the 30th of April, the panic hit its peak. Brent crude touched $126 a barrel, the highest in 4 years. Gas hit $4.30. Every headline started using the same three words: the 1970s. And then the fear started leaking out. Because here is the beautiful, stupid thing about a fear premium. The same way it inflates the price on the way up, it deflates it on the way down. And nothing deflates fear like the word ceasefire. In the middle of June, mediators got the United States and Iran to sign a deal. The strait would reopen, the blockade would lift, and traders, who had spent 4 months pricing in the apocalypse, suddenly had to price in peace. The selling was brutal. Oil dropped for days straight, down about a fifth in a single month, back to where we started. But the war ending was only half of why it fell. Watch what the rest of the oil world did during the panic. OPEC, the cartel that is supposed to defend high prices, did the opposite. They kept raising output, hike after hike, 4 times during the crisis, basically pumping oil into the fear to grab market share for the moment the strait reopened. And the high prices had quietly poisoned demand. $4 gas made people drive less, fly less, buy less. The same agencies that warned the world was running short in the spring flipped completely. Now they are warning about the opposite problem, a glut, a possible oil surplus of around 5 million barrels a day in 2027. So in about 8 weeks, the story went from the world is running out of oil to the world has way too much oil. Same planet, same barrels, just a different mood. And here is the insult stacked on top of the injury. When oil ticks up, your gas station reprices within the hour. But when oil falls back down, they take their sweet time. Economists actually have a name for this. They call it rockets and feathers. Prices go up like a rocket and drift back down like a feather. So even now, with crude back in the 70s, the sign at your station might still be quietly charging you for a war that is already ending. And that is the lesson hiding in this whole mess. You were never really paying for oil. You were paying for how scared the market was about oil. But I told you it gets weirder, so let me show you the 2 cracks this war opened up. Because while everyone was watching the price, 2 much bigger things shifted underneath it. First, the cartel is falling apart. Right in the middle of all this, on the 28th of April, the United Arab Emirates walked out of OPEC after 59 years. One of the richest oil producers in the group just left, so it could pump as much as it wants. The club that controls the world's oil is quietly losing its members. And second, the bigger one. For 50 years, the entire world has bought oil in US dollars. That one habit is a huge part of why the dollar rules the planet. Everyone needs oil, so everyone needs dollars. But during this war, to let certain tankers through that strait, Iran started asking to be paid in Chinese yuan, not dollars. It is small for now, but it is the most direct crack in the dollar's oil monopoly in half a century. So that is what is actually happening to oil. A 21-mile gap in the sea held the whole world economy hostage. A fear tax picked your pocket at the pump for barrels that mostly kept flowing. And the moment peace looked likely, the same fear that pumped it up came hissing back out, leaving a glut, a fracturing cartel, and a dollar that suddenly looks a little less untouchable. The oil was never really the story. The fear was the story. And you paid for it either way. So here is my real question for you, and the comments are where this gets good. When oil crashed back down, did your gas station actually drop the price? Or did they take their sweet time on the way down the way they always do? Tell me what a gallon costs where you are right now. I read these. And look, if this made you realize that the number on the gas sign is really a fear gauge in a trench coat, that is the whole point of this channel. We pull apart the ways money quietly moves out of your pocket, so the next time it happens, you see it coming. Subscribe, and the next way people lose their money lands in your feed before it lands in your life. Send this to the one friend who blames the pump price on the president, whoever it is this week. And if you want to know why the stock market can hit a record while you feel broke, that one's waiting for you next. See you there.